Welcome back. Well, for the markets, it is holding steady currently for the Nifty at just about 18,000. So let's see whether we manage to sustain those levels in today's trading session, especially on a closing basis for the week. For the Bank Nifty, it's underperforming at this point in time, so down close to 300 odd points for the Bank Nifty, down around 0.7%. We have another management which is lined up. Our next guest is Neogen Chemicals. They've reported what is a good set of third quarter results. The company saw strong revenue and profit growth, which was led by both their organic as well as their inorganic segment. Revenue was up 40%. We have with us Dr. Kanani, who is the Managing Director of Neogen Chemicals, joining in to discuss their Q3 performance. Hi, sir. Welcome to the show. Well, if we could just start by talking about this revenue growth. What led to this 40% growth? What can you guide us in terms of value as well as volume growth this quarter? And what might the trajectory be?
Hi, so thanks for having me here. The growth which we saw in Q3 mainly came with higher utilization of our Dahej facility. So this facility came online in September, October 2021. And slowly now this is coming to full utilization. So we are expecting maybe by next quarter or the quarter after we'll reach full utilization. So we expect to continue quarter-on-quarter growth as well as year-on-year growth in next couple of quarters as well. And the other factor which led to growth was the higher prices of lithium. So the lithium prices are high, and there are very few companies worldwide who's able to get lithium because of the shortage. So Neogen is one of the companies with almost 30 years of experience in lithium chemistry. We are able to, we saw also volume growth in lithium as well as the price. So both together allowed us to increase revenue almost to the extent of 40%. And we continue the growth trajectory. We've been throughout this quarter backed on the lithium prices, and also the main contributor also is the increase in organic production.
Okay, all right. Hi, Dr. Kanani. Thanks so much for joining in. Well, good to see a top line growth, but margins have come down to around 16.5%. You want to hold on to these levels? Does it go back to around 18%, or do you see further pressure from here?
So what's happening is the lithium prices have increased 6 times, 7 times. So we are passing on this increased price. So on an absolute basis, we had guided for 600 crores and 600 crores of top line and EBITDA of around 110 crore. So we already achieved 80 crore in the first 3 quarters. So we are already exceeding this rate. It's only the additional price of lithium. So if you correct for the additional price of lithium, the margins are still 18.5 to 19%, what are our usual. So we are waiting for lithium price to stabilize a bit. But yeah, if the lithium price remains at this level, the margins will be somewhere between 16 to 17%. As the organic utilization improves, as our product mix changes, as the new plant gets more and more stabilized, the margins would go beyond 18% in future.
Okay, all right. So that's a strong margin guidance coming in. Generally, the second half is stronger for you. You've delivered in Q3. What is Q4 looking like? Are you is it in line with your expectations? And what about key markets such as Europe? Because that's when the orders tend to pick up, right? Post-January. Is that taking place as per your expectations and internal assessments?
Yes, so we are still seeing Q4 a bit higher than Q3, as we usually always see. And also, we are seeing good requirements coming in from Europe. So the pharma segment is a little bit slower, just generally Europe, India, everywhere. So the main challenge has been a little bit of that. But you've seen improvement as compared to Q1 and Q2, what we had seen, we've seen improvement in Q3. And we are also hoping Q4 continues in the same direction.
Okay, all right. Dr. Kanani, if quarter 4 is as good or better than quarter 3, then you will be ending this year at close to around, roughly around 780 crores or 680 crores, 650 to 680 crores?
Yeah, so our guidance is between 675 to 700 crores
okay.
To end this year.
So 675 to 700 crores for this year. And for next year, on that sort of a base with capacities ramping up, what kind of a growth are you looking at?
So even next year, on the stable lithium price, we had guided at around 750 crores earlier. So with everything remaining on track and lithium prices remaining on a higher basis, so with the lithium price correction, we might be like a 800 crore plus kind of a revenue for next financial year. And overall, we've also, announced a 450 crore additional capex through our subsidiary in lithium. So for next 2 to 3 years, we are trying to achieve at least a 30% compounded annual growth rate from FY23 to, let's say, FY26, 27, up to that.
Okay, that's exactly what I just wanted to ask you about, because you have an FY26-27 guidance of around 2,000 to 2,250 crores in terms of revenue. Tell us, what is the key segment that is going to drive the growth to revenues of those of that level, one, and two, this capex of around 450 crores, you're managing to, or you want to execute this capex with your debt to equity being maintained at current levels. So tell us, how exactly is this capex going to be funded?
Sure. So I think our regular business of pharma and agro is constantly growing. We are launching new advanced intermediates. Our CSM business is also growing, which we work with the innovators on a contract manufacturing basis, not only in pharma agro, but we also added now flavors, fragrance, and specialty or electronic chemical segments. So I think that business will continue to grow at 15, 20, 25% in that range for the next 2 to 3 years. But what is making a bigger difference is the lithium battery material. So we are expecting, based on projections from most of the customers in India, that somewhere in 2024, the lithium cell production, the trial production should start. And 2025 and 26, we will see a big ramp up in lithium cell production in India.
Okay.
So basically, Neogen has been working on this for last 3 years. Our pilot facilities or the trial facilities are coming online already this year. So this 450 crore is basically geared towards meeting India's, rapid ramp up in, let's say, 2025 and 2026.
Okay.
So this is the... Yeah.
All right, Dr. Kanani, very quickly before we let you go, out of this 450 crores, how do you fund it? Point number one. What is the asset turn? Point number two, on this 450 you're putting out, how much comes in terms of revenues? And point number three, when does this get commissioned? Very quickly.
So it's going to get commissioned in phases, and we are looking at the revenue potential from this. We are already guided between 1,000 to 1,200 crores. So the asset turn will be around 2.5, which is similar to what we have. And in terms of funding, we already had raised 225 crores. So we have some of the cash which we've kept it aside as investment. So partly it is going to come from that, and partly is going to come from debt. So currently our asset debt equity is below 1. But during next 2-3 years, as this cash gets deployed, our estimate and projection show will be maximum at around between 1 and 1.25 without raising any fresh equity.
Okay, all right, Dr. Kanani, we're going to leave it on that note. Thanks very much for joining in and talking to us. So that's Neogen Chemicals. Strong guidance for this year as well as going into FY26 and 27. They do have capex of around 450 crores, which is coming up. Not to mention that they do expect the margins to probably move towards the 18% mark. Time for a short break. More stocks on the other side.